Hello traders, it's Victor from TRADEPRO Academy. I hope everyone is doing well. And in today's video, we are going to be talking about futures. Now, we're going to be talking about price action in futures. Price action is one of the most basic rudimentary tools that any trader realistically, no matter what product, should be acquainted with. Now, that doesn't mean that price action is the be all and end all, especially when trading futures. But in today's video, we're going to break down a lot of the key concepts of price action that you should be aware of, mainly trends, before we dive into other subsequent videos with more definition on the futures market, order flow, volume profiles, risk management, and all that good stuff. So keep that in mind as we get started with this video. Now, throughout this video, we're going to deep dive into the price action. These are the basics that every trader must need to know, from basics to advanced. So if you guys are excited about this video, drop a comment down below. Do you guys use price action? Is that your predominant tool in technical analysis? Or is it something else? Hit that like button, hit that subscribe button, and let's get into this intro and dive into this video. Now, price action and chart movement can give you foresight in what is expected of the market and the market's movement. Realistically, there is a few other tools that can help us qualify and quantify the expected moves. Of price action is one of the main tools that a lot of traders do come by. Now, throughout this video, we're going to be using a platform called Sierra Charts, and we're going to be mainly talking about the S&P 500 E-mini futures throughout this video and subsequent videos to come when we do talk about futures. When we talk about market trends, right, there's three main trends that we do have to be accustomed with, and they're the bull trend, the bear trend, and a range, right? The markets do tend to range and move in oscillating sideways fashions for the majority of the time and exhibit general trends up and down on shorter occasions, especially when we're talking about intraday trading or just generally smaller time frame trading. Now, to break down each one of these trends in the simplest of forms, we're not going to get too much into this. We're going to go step by step. If we talk about the bull trend is characterized by higher highs and higher lows. Very simply put, as the bull trend continues, we will need to see higher highs at least to continue the price action movement. Now, there is a scenario where the bull trend can continue without actually printing a higher low. Now, that comes into the whole concept of finding impulse moves. And this is more of a demand and supply type price action and market structure. Now, the demand zone is going to be the prior higher low, and you can see this on the screen right now. We'll show you a few examples as well. But the demand zone or the prior higher low is going to be the area that we at least need to hold for this trend to continue. Now, this would subsequently make an equally high low, but the very strong caveat here is that this will have to result in a higher high for this bull trend to continue. Now, there's a point in which you can identify reversals in the bull trend. Now, there's two main concepts that go with that. Number one, the easiest way to identify that maybe a bull trend is starting to break is going to be the break of that demand zone, where we don't actually hold the prior higher low, but instead we actually break down through that higher low and start shifting the gears more so to maybe a range or a downside market. Now, the second part of a break of a bull zone is going to be very similar, and it's going to be in that we create a lower high. So instead of making a new high and continuing this trend, higher highs and higher lows as the bull is known to go, we instead fail to make a new high and drop just shy of that prior high and start to curl back down. In this case, I would expect that demand zone or that impulse zone, which is the subsequent equal higher low, to actually break down. Now, the combination of those two things with a lower high in the bull trend and a break of that impulse zone or that demand zone is going to shift the market from a bull trend into what we could see maybe neutral or even a bearish move. Now, with the bull trend, we can transition into a range trade or a bear trade. If we talk about the bear trend is usually classified by lower lows and lower highs. Very easy to follow. Now, ideally, both trends in both scenarios are going to be picture perfect in that they do hold those scenarios, lower lows and lower highs, but it's not always the case. Now, the bear trend, picture perfect bear trend, lower lows, lower highs. The same concepts apply. We have a lower high area, right, which is going to be our supply zone or impulse area. that impulse area is going to be a huge barrier for that bear trend to continue. Now imagine you have that huge resistance that was created by a lower high. That needs to hold out for this bear to continue. And then the second caveat is that we do need to press a lower low through the prior low from that supply zone. That is the least the bear can do. Ideally, with the bull and the bear, the prior highs in the bull will act as support. The prior lows in the bear will act as resistance, but that's not always the case. We can land somewhere between the impulse and that low on the bear move, and that's fine as long as lower lows and lower highs continue. Just like the bull, if we start printing a higher low and fail to break a new low, the idea is we're going to see how that impulse or that supply zone that was made on the bear side reacts to this action. So we're going to need to see how that area kind of unfolds. And if we do break back above it, that is the break of the bear trend. That's where we start to break these things down and we start actually seeing a reversal, which can turn into a range or subsequently can turn into a bull move. So keep that in mind. And the final trend that we can see, these are again basics, is going to be a range trade where the highs and the lows are equal. Each time we just oscillate between highs and lows, a key support and key resistance zone. In this case, it's very, very simple. If we break throughout each of these regions, we are going to see an extension in that direction. Now, when it comes down to these trends, these were just very basic go-throughs, right? We just little revisit of what these trends look like, how they can hold, how they can break. Those examples should have helped. But right now, when we talk more about price action and price action with futures trading, there is always a debate. What kind of charting should I be focused on? What kind of charting should I be using when I'm actually trading futures? Now, the debate is between time charts versus everyone else, right? There's multiple different other charting systems and different ways to chart futures other than time charts, and time charts are pretty much the staple. I think everyone knows what a time chart is, a candlestick time chart. But the other chart that I do want to focus on is going to be a range chart. Now, what a range chart is that it continues to hold a candle, not based on time, but based on actual movement. For example, the S&P futures, they move tick by tick. Each tick is a quarter of a point. So that means if I have a 10 range chart, that's a 10 tick chart, you're gonna have 10 ticks in that chart or 2.5 points. Now, a new candle will not form unless we move one direction or another 2.5 points, right? From open to close. Now, it's the same thing if you have a 20 tick chart. Instead, you're going to have a 5-point movement, right? 20 ticks of movement until the next candle's formed. Whatever the denomination you choose is, you're going to have to wait for that movement rather than time. It could take 10 minutes, 15 minutes, 3 minutes for that individual candle to form based on the range that you have. It's not directly correlated to time. Whereas you have a time chart, every 5 minutes, you know you're going to get a new 5-minute candle. I prefer to focus mainly on the 10 tick range chart. And of course, there's both pros and cons to using time charts versus range charts. So let's break those down. With time charts, one of the main pros is that you see each incremental movement equal, right? And with that, each candle will have wicks, bodies, whatever the case may be. Now, strong bodied candles on a 5-minute, 3-minute, whatever type of chart that you look at is going to present unbridled strength realistically. If you have a 20-point move in one single 5-minute candle, that is strength to whatever side that movement is. With candlestick charts, another thing that you have is the ability to do multiple time frame analysis. So whenever you're looking at a time chart, maybe you start with a 1 hour, then drop down to a 10 and a 5-minute, you can see what the general trend is, what the strength in the market is based on each individual candle. Like an hourly candle, if that closes really green, maybe there's strength in the buy side, and then you dive deeper and deeper. Whereas with time charts, one of the cons is that it is subject specifically to time. And futures, right, they have specific movement, and their movement is based on ticks. So the range charts, their main pro is that they're not subsequent to time, right? They're not subjected to time. They're mainly subjected to the actual price movement in the underlying asset, in that product. So what you're looking at with those range charts is you're getting more minute movements, right? You're getting more minute movements. And if the market's slow, you're not getting any real movement at all, right? Which is one of the cons actually. But with that more minute movement in the futures market with those range bars, you can identify what the strength in the market is fairly quickly, right? You can identify where the higher lows, higher highs, all of that trending within an individual session much, much quicker than you might be able to with a time chart. You can also find structural changes, trend changes a little quicker because of that very minute movement in a range chart. Again, one of the main disadvantages on the time charts is that we talked about that each candle is a specific time allotment, right? 5 minutes, 10 minutes, whatever the case may be. And of course, it's subject to wicks, it's subject to full bodies. Now, the main disadvantage with this is that futures markets, right, they move on very small increments, right, which is advantageous to the range charts with those minute little charts. They move based on small increments, a quarter of a point. Now, a wick could be 5-10 points. And with those large wicks, with those large head fakes on time charts, you can get easily stopped out and wicked out of positions and really pushed aside if you don't have a large enough stop. Now, there's an advantage to using both a time chart and a range bar chart cohesively. Which brings us into the next area. How can we look at both these charts? How can we look at a time chart and a range chart to identify areas to trade and maybe areas not to trade? It's not necessarily as simple as finding highs and lows, peaks and valleys, rotations, and just plotting levels there, right? There's a little more to it and we'll get right into that. But with time charts and range charts, we can use both of them cohesively to actually find those key areas based on price action, supply and demand zones, key support resistances, to actually find areas where we could trade versus not trade. Now, if you watch some of our other videos based on volume profile, you'll see that you can use the volume profile plus these tips and tricks that I'm going to show you guys to find those mega pristine levels, those large areas that we must be interested in. Because if you take a look at a chart, whether it's a 10 tick, whether it's a time chart, if you start slapping levels every 3-5 points, you're going to get confused. You're going to miss out on the big levels and you're going to have a tough time finding trends and trading off of those areas. So instead of doing that, why don't we try this instead? So let's go over to the computer and break this down, show you examples, and put everything that we've learned about price action together.
Hello, everyone. All right, we've made it to the computer here, and we've got in front of us a chart. Now, this is the S&P 500 futures chart, and what we're going to be doing is breaking down the price action areas, the support resistance areas that we could use, and how we can do them the right way on this futures chart. Now, what we're going to be doing is using TradingView along with Sierra chart, right? We're going to start off on TradingView because I'm going to be looking at both a time chart and a range-based chart to identify some of those levels. Now, a lot of this can be done with multiple time frame analysis, but since we're trading on an intraday basis, right, I would like to dive into some more minute time frames more so than looking at these larger levels, for example, on the daily to start off with. Now, naturally, you can pinpoint some of these levels, right, if you're grabbing some of these wicks and tops, but just take a look at this, for example. This is what I mean by this. If we grab the top of this candle, it's at 43.15, right? We grab the top of this one, it's closer to 43.30. That's about 13 to 15 points on the S&P 500 futures. Now, for those that don't know, we do have a $50 per point increment on the futures. If we have 15 points of an area, that is a potential gain or loss of $750 per each contract. So what I want to do right here is just focus on, we start off with the hourly, right? With the hourly, we can identify some of these key support resistance areas based on where we have large impulse moves that we could call demand or supply zones, or where we have general support resistance areas. So we can start off with an area where price has failed multiple times. Now, keep in mind that I don't necessarily want to draw levels at every opportunity that we have, right? At every level that we have. I'm just going to drag a simple horizontal ray here on TradingView, and we can pinpoint some of these areas. You can see we failed multiple times at this zone, right? We have a key supply zone right here where we have that large impulse. We have that large impulse move. The same thing here where we can identify that key impulse that starts. We have that supply zone that starts that large impulse move. So right away, we slap down two levels here on the futures on this hourly chart. Now, we can start off by identifying where these impulse moves start here on the support zone, right? Where we can have some of these demand moves where we have the start of this move. We have the start of this move, give or take a few points, right? It's not going to be super exact. Obviously, we do have these lows here on the hourly, right? We can see where we have those tag lows here. We have this impulse move start. We have an impulse move start from this area where we could identify some of those support resistance areas based on this hourly, right? We can jot some of these levels down here too. We can see an area that's been tested multiple times, right? We have multiple tests here. We have multiple tests here, right? Support now turns into resistance in this area. And then we get kind of a cluster right here. Now there's some more areas that we could draw naturally based on some of these prior support resistance areas. You can see multiple tests of this area in and around that 40 region, right? Just above that 40 region that manages to hold out here as well. And we get this very nice wick from that area that shapes up there. So if we can draw something like this right into the lower 40s there, that works perfectly as well. Now, these are a lot of the main areas that we can see on this hourly chart. And you can see they're very scattered. Obviously, there are things in between. And for something like that, right, maybe we might want to look at this hourly chart. Maybe if you're a little confused as to where to drop these areas, we can look at a 10 or 20 tick, right? We could also look at a volume profile, which you can see in multiple other videos, but we have an area somewhere right here around that 72 as well. And then it becomes somewhat of a mystery other than that. So you can do one of multiple things here, right? You can drop down to a 10-minute and look at where these key supply and demand zones might be, where these key support resistance areas might be on this 10-minute, or you can go to a 20 tick chart, which we can find here on Sierra chart, and simply we can just type in 20 and enter to get that 20 tick chart. And what we're going to be looking at in this area is going to be, let's just zoom out here on this 20 tick chart. What we can look at in this area is going to be, again, points of inflection. Now, you can see the price movement based on the 20 tick versus this 10-minute is very, very different, right? You can see multiple rotations because, again, a tick chart is going to be based on the actual movement rather than the actual time for each candlestick and for each candle movement. So we can look at this, right? We can move some of these levels, but the main thing is we can draw the impulse areas where price actually starts from, right? You can see this is more of an impulse area where price manages to make that push, And these are, again, supply and demand zones that we can identify, and you can readjust, right? Multiple tests of areas, so on and so forth. Now, with the 20 tick, I just want to focus on key points of inflection rather than having every single minute level. You can see, right, between 37 and about 47, we have 10 points, right? These areas should be, I'd say, around 7 to 10 points apart to identify those larger, more key areas. You can see where we've identified these areas are points of inflection, demand zones where we actually start that pop, right? Points of inflection, those demand zones, points of inflection here, multiple inflection points, right? And here you can see a few more. And the more you find these points of inflection, right, on a 20 tick, a 10-minute, whatever the case may be, the better the opportunity is to find those key areas, right? Where you see massive, massive rejections. Those are the areas that you'd want to start with before you get into actually trading, actually looking at what's going on. Then you can take a look at the overall trend, right? Remember we talked about higher highs, higher lows, right? Bull trends, bear trends, sideways trends, all that stuff. And you can see, right? What are we exhibiting in this specific example, right? We're seeing very, very defined higher highs and higher lows, right? Higher highs, higher lows, right? This area, right? A little inflection point here. What happens in this zone is that we fail to make a new high, which would bring around a potential reverse. Remember, this is going to be the demand zone area or the area where we have that impulse move, right? To attempt right here to make a new high. We pull back down to the same zone. We fail to make a new high. And what is the expected move to get a drop back down to the downside? And then now that impulse move turns into a resistance. But again, we fail to make a low here. What happens? We continue this upside trend until, right, maybe something breaks, maybe something doesn't. So with that, we can identify a very simple way to break down price action, understand trends, understand where our areas are, how to draw our areas. And with that, we can take the next step into understanding what zones to trade in on futures, right? We don't want to trade all these minute levels because when I looked at this chart, for example, we stopped at a certain point because I could throw a level here. Every inflection point, I could throw a level theoretically. I stopped because we don't want to have areas where they're like 3-4 points apart. We want to make sure that those are the massive key areas, and you can get those from a 20 tick and mainly an hourly chart, right? You can see with this hourly, it gets a little confusing. That's why we pulled over that 20 tick chart to give us a better understanding of what is going on in this market. So to wrap this up, right, let's do a little outro. I hope you guys enjoyed these levels. Drop a comment down below how you might draw your levels, and if you have any questions about these levels, and let's see what we got to say to end this video.
So I hope you guys really enjoyed that video. We talked everything about price action, the basics, from trends to time charts versus range charts to areas where we can identify trades versus maybe not so strong areas, how to draw zones to trade in, and then we put it all together. So I hope you really enjoyed that video. Let me know what you thought about it down below. Drop a comment if you trade mainly price action, and we'll see you in our other videos where we're going to be talking about order flow, where we're going to be talking about volume profile, and combining all of these together to identify how we correctly trade futures at TRADEPRO Academy, how you can correctly trade futures and cut out all the crap in the middle that you might have learned from before or whatever's on the internet right now. So I'll see you guys next time, and don't forget to smash that like button, smash that subscribe button, and this is Victoria from TRADEPRO Academy.